Hello, finance experts. My name is Connor Berthelot. Today I'm going to be doing my ratio analysis on the mass retail industry and the semiconductor industry. So, first, we want to look at what are we looking at today. We're going to be looking at solvency, profitability, and market value. And what I mean by this is we're going to be looking at, can the firm pay its short and long-term debts? Is the firm cash flow positive, and is it growing? And what does the market think of this firm? So the first industry we're going to be looking at is mass retail. So we're going to be looking at firms such as Walmart, Dollar General, Target, Costco, and I also threw in Amazon as kind of a contrast to these traditional retail outlets. I decided to do an e-commerce outlet as well. So the first thing we want to look at is short-term solvency. Here we just want to see, is the firm going to be able to pay its short-term debts? So looking at the current ratio here, we see that all of the firms except Walmart and Target are going to be above that crucial 1 for their current ratio. Walmart and Target are both fairly close, but both of them are slightly below. I don't think it's any cause for concern, but they are below 1. When we look at the quick ratio, we see a little bit more of a problem, particularly with Dollar General. Dollar General has a very high current ratio, in fact, the highest of all of them. But when we look at their quick ratio, it's actually the lowest. So what that tells us is Dollar General is completely tied up in inventory. All of their assets are going to be, all of their current assets at least, are going to be tied up in their inventory. And that's going to make it a little bit more inflexible should they need to pivot or anything like that. Amazon breaks that trend completely by keeping their inventory very low. Kind of one of the benefits of being an online retailer is that you can sell third-party items as well. You don't have to keep all of the inventory in your warehouses. So that's a little benefit from them. Looking at the current ratio here, we can kind of see some graphs, some time trend analysis, as well as just get a little better picture of it. So you see Dollar General significantly higher in the current ratio, but when we look at quick ratio, you see how low that is. And then again, you see Amazon just to break away from all the other firms because of their e-commerce status. Costco also does a really good job of keeping their inventories low. Helps with flexibility, like I said. So here we have the long-term solvency. So this is, to me, a little bit more important than short-term solvency because this is going to show us both how leveraged are they, how risky are they, and can they pay back their debts? More importantly, can they pay back their debts? So we're going to look at total debt ratio for kind of our measure of long-term solvency and long-term debt. Basically, this number is just going to represent how much debt they have relative to their assets. So I kind of group these into 2 categories, the safe and steady and the high growth. So the safe and steadies are the Walmart, Dollar General, and Costco. All of them are going to be below 30% debt. So they like to keep it low, not as leveraged. And then the high growth are Target and Amazon. Both of them, high amounts of debt. Debt is cheaper than equity, so they're getting their funding a little bit cheaper, but they are taking a little bit more risk. So when we look at times interest earned, this is really important to can they pay back their debts. So all the times interest earned are really high. Amazon is a little bit worrisome at 3.73-ish, but not really any concern there. Costco 25, Dollar General 21, but those are extremely high. Walmart and Target both very good. So there we have the total debt ratios that I was talking about. You can see they're all in a manageable, group there. Nothing's too high, nothing's too low. Times interest earned, you can really see the breakaway in Costco and Dollar General looking at that. So you can see they're definitely able to pay back any debt. So what have we learned? All the firms look safe in the short term, except for Dollar General's kind of quick ratio that I talked about, maybe makes them a little inflexible. Leverage varies between firms, with Target and Amazon being the most leverage and Costco being the least. So like I said, high growth and safe and steady. Preference varies between risk avoidance and expectations. So, if you expect a recession, you might want one of those safe and steadies. If you really are looking for more growth, maybe you're going to want to run, an Amazon or something like that. And all the firms are able to pay their debt. so no problems there. So next we have one of the most important aspects, the return on equity. Here we're going to see how profitable all of our firms are. Um, so looking at it, it looks like all of our firms are staying right around that 25, 26. Amazon's a little higher at 28, but are all around that range except for Walmart. Walmart has a low 8, and it's trending downward. So where we have Target that's really trending up, it had some struggles back in 2015. When we look at Amazon, also had some struggles in 2015, trending upwards as well. They're doing great. Walmart not doing too hot, trending down. And we're going to look at why in a second. We're going to do our ROE decomposition. So this is a nice little graphic. Shows you exactly what ROE breaks down into. So it breaks down the return on assets and leverage ratio, which is what we're going to look at first. So return on assets, we see Dollar General really crushing that return on assets. That's what's leading to their high ROE. We can already tell that. All of our other firms, except for them and Walmart, kind of at a consistent level. Walmart's a little bit low. Maybe that's what's causing the lower ROE. We're going to look a little bit deeper. When we look at leverage, we see that Amazon has the most leverage, but they're actually lowering their leverage as their ROA increases. So they're making sure to manage that really well so that they keep their ROE at a good level while taking as little risk as possible. So it's really smart for them. Target's doing a similar thing. They're actually increasing their leverage though, just to make sure that that ROE is at that similar level. All of our other firms keeping their leverage pretty low and in a steady little spot. Looks like between 2 and 3. So not too bad. Next, we're going to break down ROA and see maybe what some positives and negatives are there. So when we look at the profit margin and the asset turnover, we see Dollar General's crushing with their profit margin. So that's probably what's leading to their good ROA. Amazon, Target, middle of the road, they're doing all right. And it looks like Walmart and Costco really rely more on their asset turnovers, as we can see here. Costco, extremely high asset turnover. Walmart lagging a little bit. Probably looking at the profit margins between the two as well. It looks like both these firms rely more on their asset turnover than they do their profit margin, so they're just trying to get their inventory out as quickly as possible. So Walmart probably wants to focus on that asset turnover in the future as being their way to increase their ROA and thus increase their ROE. The other three firms, asset turnover, very low, probably a goal of theirs, not to really worry about asset turnover, really worry more about margins. So let's look at the margin, the profit margin, what that breaks down into. So operating margin, Dollar General is really high, so that's what's going to lead to their high profit margin, and that's going to lead to their high ROA, and then that's going to lead to their high ROE. All the other firms, pretty steady operating margins. You see Amazon's is growing over time, which is really good to see. Tax burden and interest burden, both relatively constant. We have a few outliers in 2015 from both Amazon and Target. And then as well, interest burden, you have some outliers from Amazon, but nothing too crazy in the last few years. So all that's pretty constant. So what have we learned? All the firms have similar ROEs except for Walmart's low ROE. Amazon and Target use higher leverage to make up for their low ROA, as we talked about. They seem to have a goal ROE they're trying to hit. Amazon is lowering their leverage as they raise their ROA, and Target is raising their leverage as their ROA kind of naturally drifts lower. Dollar General has a high ROA, and this is due to their operating margin, which leads to high profit margin, which leads to that high ROA. And Walmart's main issue with low ROA is low asset turnover, it seems. So they really want to focus on more asset turnover rather than the margins being the cheapest shop around. It's going to hurt the margins. So if they can get more volume, more turnover, that's going to help the bottom line much more than actually margins. So now we're going to look at the dividend discount model. This is just going to give us a quick glance at what is kind of the overpriced, underpriced for the market. So we have Costco overvalued, almost doubled actually. what their theoretical price should be, which is pretty interesting because I actually thought that they looked pretty good from other analysis, kind of safe and steady, but nothing too bad. Amazon is extremely undervalued, at least according to the dividend discount model. Almost 2,000 compared to almost 7,000 is 350% difference. So really undervalued from that. Dollar General, a little bit undervalued. Target, they pretty much got it on the head, 87 to 88. Kind of be nitpicking to say that's undervalued. And then Walmart, overvalued again, around double, or close to it, what they think it should be. So which stock is my favorite? I have to go with Amazon. It has the highest dividend discount model, theoretical price. Its ROE is growing the most, meaning more potential profit. And it also has the highest current ratio, which isn't as important, but at least it gives you, less cause to worry, at least in the short term. So next, we're going to move on to the semiconductor industry. So our five firms there are going to be Advanced Micro Devices, or AMD, Intel Corporation, NVIDIA, Qualcomm, and Micron. So here we have some short-term solvency ratios. Again, we're just going to be looking at current and quick ratio, not as important, especially in this industry. All of these ratios are extremely high. All of them are obviously liquid. The lowest one here is going to be 1.5 for 2019. Still very high. Quick ratio as well. This kind of shows they're not really super worried about inventory as much as other industries might be. All of them are pretty similar to their current ratio. All of them are extremely liquid. Don't really need to worry about it. You can see here, current ratio, super high. Quick ratio, very high, especially for NVIDIA for both of these. So next we're going to be looking at long-term solvency. So total debt ratio and times interest earned ratio. Fun fact, Qualcomm did not have any debt until Q3 of 2015. So for the entire company history up until 2015, they had no debt. Since then, they are now 50% debt, so 50% debt, 50% equity, which is an extremely high debt ratio. Very risky. The debt's very cheap, but definitely very risky. And it looks like Micron and NVIDIA both like to keep their debts really low, 10% and 15% or so. Very low, both of them. For times interest earned, we have some interesting things. AMD had a few problems paying their interest debts back in 2015, 2016, and 2017. More recently, they've been recovering 2018 and 2019, but still pretty low. Definitely something to look at. Qualcomm as well seems to be lowering pretty rapidly. Recently they haven't been able to keep up, so we'll have to see if they're going to keep declining to that level. Other than that, all of these firms seem very able to pay their debts. Intel, Micron, and NVIDIA all have over 24, so definitely able to pay any debts. Here's the total debt ratio again. So you see AMD extremely high, lowering drastically to a pretty even level. 29% is not too bad. Meanwhile, Qualcomm going the opposite direction from literally 0% debt all the way up to 50. Really bad trend to see. And again, we have a little mirrored, just like we did in the first industry, for these. So as debt goes up, times interest earned goes down. We see that in Qualcomm, and then as debt goes down, times interest earned goes up. We see that in AMD. So what have we learned here? Qualcomm seems to be headed to bankruptcy. They're taking on a lot of debt very quickly, and recently they have not been able to pay that off. AMD, on the other hand, has done a good job recovering from too much debt. They're at 75%, now they're around 30. They're able to pay back all their interest debts now, so they're doing well. NVIDIA, great at keeping their debt low. And Micron also had a little bit too much debt, now extremely low on the very low end. In fact, I think they have the lowest debt ratio. So now, again, we have the most important thing, profitability and return on equity. So here we're going to see how much growth, how much profit we can look at. So as we look, the first thing that draws the eye is AMD. going from -110 to 36. So really good job recovering their ROE there over the last few years. They just got to the positive this year, so it's still kind of worrying. It's not exactly something I'd be looking into, but it is good to see them increase. Might be a good future investment. Qualcomm dipping into the negatives here, which is strange because all the past few years have been positive, and so they actually have a good reason for that. We'll see when we dive deeper into this. All the other firms keep it around a good range from 29 to 55, so really high return on equities there for all these firms. So that's a really good trend. So here we see ROA is kind of driving ROE in all of our firms. So we see Qualcomm struggling in ROA as well as ROE. Viewing NVIDIA, Micron and NVIDIA, very high ROA driving their ROE. And AMD growth is encouraging just like it is for ROE. Qualcomm is actually dipping into the negatives here, which is particularly bad because of how high their leverage is. Leverage does magnify gains, but it also magnifies losses. So having a negative ROA in a highly leveraged firm is a extreme no-no. In fact, Qualcomm's leverage is so high it broke my graph. Most of these firms hover around 1 to 2, which is a pretty ordinary leverage ratio. Qualcomm's actually at 40, so it's pretty significant. AMD was very high at around 20. They've been able to lower it very well. Still a little bit high, but it's good at keeping their ROE at a good level. All the other firms are around 1.5 to 2 times leverage, like I said, so they're doing pretty well with their leverage. Qualcomm definitely needs to worry about that debt a little bit. So as we break down ROA a little bit more, though, we see some profit margin and asset turnover ratios. So again, Qualcomm dipping into the negatives for profit margin. Not doing great there, but like I said, we'll see the reason in a second. Micron and NVIDIA both have high profit margins, both have high ROAs, both have high ROE, so we can say that profit margin is probably driving that. AMD is growing, but still weak. So besides Micron's little dip there, still the lowest. So they really want to worry a little bit more about their profit margin. They're doing well on their asset turnover. They're actually leading the pack with both Micron and NVIDIA doing pretty well as well. Intel and Qualcomm not struggling. They're doing fine, but maybe could increase a little bit. So now we're going to dive into the profit margin. So here we're going to see operating margins are actually doing, all right for Qualcomm, not great. But it wouldn't explain the low numbers. What would explain that is their tax burden here. They had an extremely low negative tax burden. It was something like negative 800%. So I did some research online. Found out that after the Trump tax bill passed, they decided to reclassify some of their assets as U.S.-based assets instead of foreign assets. And so that increased their U.S. taxes, of course. But those are all tax deductible, all these tax increases. So they'll be able to leverage that against their next few tax seasons, which should inspire some growth in the company. Looking at operating margin again, Qualcomm does need a little bit of help with that. AMD as well, both of them are kind of struggling. All the rest of the firms doing well. Interest burden, pretty consistent. We have a dip from NVIDIA there in 2017, but other than that, all very consistent. AMD's kind of all over the place as usual, but doing pretty decent. So what did we learn? Qualcomm's dip in ROE is due to a one-time tax event, so it should bounce back next year and the next couple years as well. Micron and NVIDIA both maintain high ROEs due to high profit margins and asset turnover rates, so they're doing well in both metrics. Advanced Micro Devices is growing its ROE, but it is still low, so they still need to grow that a little bit more. And Intel's ROE is steady, but not impressive. Intel has kind of been not talked about too much because they haven't impressed me, but they're not doing bad. So looking at the dividend discount method was really surprising for this. All of our firms are overvalued except for Qualcomm, the one that I thought was extremely risky and overvalued. So Qualcomm's actually undervalued according to this. looking at this makes me a little less, focused on it. But that's going to be it for me, guys. Thank you so much for watching. Hope you have a great night.